Hello traders, and welcome to a new video on options, hedging, and combination strategies that we can use to make it very likely that we make a profit. So what I want to go over today is looking at call and put spreads, which are really the simpler kinds of option strategies, and then we're going to look at how to hedge positions when we're long or when we're short so that we don't have to use a stop loss and we still have good risk management. So all the fun without the pain. Additionally, my Master of the Books guide is currently on sale. It teaches order depth, order book, and order flow trading. And if you want to learn more or are interested in getting it, you can click the link in the description below and start trading order depth to your heart's desire. Now, what I want to start this video off with is a call spread, and then we're going to look at a put spread. Now, using a call spread, really what we're doing is we're betting on low volatility and we're betting on the market going up. The benefit of this is we have a fixed loss. We cannot lose more than the difference between these two premiums. I'm going to show what that looks like. And also, we have a fixed gain because it's just the difference between these two. Now, what we want to do with this is, let's imagine we want to buy a call. You always want to buy a call with a lower strike price and sell a call for a higher strike price when you're using a call spread. You can kind of see a bit of the art behind me. This is not my house. This is a different house, but that is good art. Okay. Back to options and not art. Let's go look at the premiums that we would pay for a strike at 9,000 for a call. We could probably pick it up for 0.079, I think. So I'm going to put 0.079, and we could sell a call, the 9,500 call for 0.0555, I think is fair. So if we were to do this, then our potential max profit would be around 283. Our potential max loss would be 216, as you can see here. Now, what would end up happening is our peak profit would be at around 95.22 with a profit of 0.029, and our loss would only be 0.029, and our max loss will only be 0.0235, as you can see here. So with this kind of setup, really what you have are great profits around here and just a potential max loss here. Remember, this is the graph in BTC and this is the graph in USD. So that's why it looks this way, as you can see here. So that's all fun and dandy. Let's go look at the put spread. Put spread, we're just doing the same thing. It's just that we're going to buy a 9,500 put and sell a 9,000 put. Yeah. Now, when we buy 9,500, we could probably buy that for 0.073. I'd venture to say so. We could sell a 9,000 put for 0.0445. I mean, we could just market sell that even. Or, yeah. Okay, how much is that going to hurt us? Let's see. Yeah, our potential max gain is 237 and max loss 262. This may look bad at first. But really what this is giving us is, as long as price is below 92.46, I mean, we make all this. It's only if price goes above 92.46, and even if it does, you have a potential capped loss here. So it doesn't matter if price is 96.60 or higher than this. And if you don't like these spreads, if you think that this isn't a great risk reward, then what you can do is you can look to get better spreads. You can look to get better premiums even. So with the puts at 9,000 and 9,500, we are paying 0.073, and 9,000 we are selling for let's just do 0.045. I think that's more fair. And if you don't like the spreads that you get for these call and put spreads, then you can just wait for a better price. Now, the interesting things about these is when you combine them, you can use both a call spread and a put spread together. Let's do that. So to do that, I'm going to copy these values here, and actually I'm going to copy all these. Boom. I'm going to put that, pun not intended, put that here. And let's go look at what this would look like in combination. So in combination, let's say price is at 86.02. We would make 0.03, and we would only lose 0.235. Let's say price was at 89.24. We'd make 0.028. We'd only lose 0.023, so we make more money than we lose. Hey, let's say price is at 96.14. Let's say price actually went up instead. We make 0.028, 0.02801, 9700, 9706, and we lose like almost the same amount. Now, wouldn't it be great if instead of seeing this on 2 lines, we could see this graphed on 1 line? That is a possibility, my friends. Let's do it. So with this combination strategy, putting it all together, what we have is if we use both a call spread and a put spread with these current values here, you're going to make a really profit or guaranteed profit. Well, guaranteed profit. You're making a profit. You're making a profit as long as price is below 97.06, and your profit just goes up. The lower price goes. If I do something like this to show all the values, this is what it looks like. This is what just a put spread would look like. This is the profit that a put spread gives you, and you just have a fixed loss. And this is what a call spread would give you. And you just have a fixed loss here, as you can see as well. When you combine them together, this is what you can make in Bitcoin, as you can see. And if I do it this way, this is what you can make in USD. So using a combination spread can be a good way to get a very good break-even price. Something like 9,700 does seem to be a good break-even price. And you can see that lower price goes, the better. Now let's go into hedges. Now the reason I wanted to show call and put spreads is they're a really good, safe way to go long or short. I mean, you don't need a stop loss when you use a call or a put spread. And when you use a call spread, you're bullish, but you are not bullish enough to just buy a call. You want to be protected from that loss, so you buy a call. You buy a call spread, and you make just more money as price goes up with a fixed amount that you peak at with making the money. Put spread, you're bearish, but you don't expect much volatility, and you make money as long as price goes down. But you have a capped loss, so you don't have to worry about a stop loss or anything. Now let's imagine we have a short position at 25,000, and the current price is 92.50. So we use that. Now we just shorted at 92.50. Imagine that. How can we protect ourselves with this short? Well, we could just buy a call to mitigate the loss from our short, or we could buy a call spread. We're buying a call and selling a call. And if we were to use a call spread, let me copy the values that I got all here. Where are those beautiful values? These guys here. There they are. I'll use that too. Let's put those guys in here. This is what would end up happening. This is your profit right now. Your break-even price is obviously 92.50 because that's where you're shorted. You make money, price goes lower. You lose money, price goes up. That's a short. If we just put on a put spread, actually no, that would not be good. If we just put on a call spread, let's do 2. If we have a call spread, then our new break-even price is about 93.40. As you can see, so you actually gained a better break-even price, even though you shorted at 92.50 because you bought a call spread. You would make money as long as price is below about 93.40. See here. And if price does end up going up, let's say price goes to 10,000, how much would you normally lose with just an unhedged position? You'd lose about 0.2 Bitcoin. 0.2. Hey, we have a call spread on. How much do we lose at 10,000? We only lose 0.147. Not as much of a loss. And let's say price goes to 9,800. We would lose 0.097 with a hedge position. And if price goes to 9,800 here, we would lose 0.15. So much bigger loss. If price goes to something like 94.35, unhedged, you lose 0.052 Bitcoin. Hedged at 94.35, you actually lose like almost nothing, 0.077. So this is good because your losses aren't going to be as large, as you can see here. I would still recommend putting a stop loss in, for this short. It's just that the reason you do this is so that you might not have to use a stop loss. And if you may wonder, well, can we still lose a lot? Well, you can, but one thing you can do is you can ramp up the position size of your options. If you make this a little bit bigger, then you're more protected from price going up. If you make this super big, then weird things start to happen. Let's make it like that. Strange things start to happen here, And if price goes to 10,000, you only lose 0.1 Bitcoin. You know, whereas before, you know, you would have lost much more. However, if price goes down and your short was correct to something like 8,500, you'd make 0.12. Unhedged, if price goes to 8,500, you make 0.21. So it's really using these kinds of hedges where you buy, where you use a call spread with a short position, or opposite, we could just do this. Long position, we could put on a put spread. We could use a put spread here. And if we do this, then we're protected if price goes lower. As you can see here. If price goes to 86.95, we only lose 0.11. You know, if price goes to 86.95 normally, we lose 0.17. So this is really just protecting you from a lot. And you know, if you ramp up the size, you're even more protected, as you can see. If I do something like this, you are really, you know, protected, and you get like profit here, draw down here, profit, you know, profit up here. All right, guys, so that's going to do it for this video. And then, well, actually, one other thing that I do want to mention, you can go long here, 92.50, and we could just buy a put. But the issue with this is that your break-even prices aren't great. You know, you make money if price goes below 8,400. You make money if price goes above 10,700. So that's why sometimes it can work to use a spread, to use a put spread when you're long, or a call spread when you're short. And there are lots of other strategies that you can use in conjunction with a live futures position. This is just one of them. You know, this is definitely one of the strategies that you can do, where you get a better break-even price because you longed at 92.50, right? But this actually says that you're long about not long at 9,000, but the overall position's at break-even as long as price is above 9,000, because you have on a put spread, whereas normally your break-even would be 92.50. So this can get you a better break-even. It limits your profits and also protects you from major losses too. All right, guys, that's going to be it for this video. If you have any questions about other ways to hedge positions besides using call and put spreads, if you have any other questions about how to use a combination spread, like something like this, or how to use a put spread or use a call spread, you know, just by itself, you can ask that in the comments below, or you can send me a private message or ask for mentoring on my website. With that, happy trading. See you guys soon.